The top 1% avoid taxes like the plague. These people, they became very wealthy, not only from their businesses, but also avoiding excessive taxation. They figured out how to play the money game. They figured out, okay, I can have this entity structure and I can set up this LLC so that it flows into this trust. And this trust is going to be, maybe an offshore trust or something like that. You don't have to do all of these things. They just understand how to play the money game in that regard. And that's because they have attorneys, accountants, analysts, all these people on staff that set up these intricate structures and show them, hey, this is how you avoid taxation, which is going to be, for most people watching this, their number one expense throughout their life. If you ask me, I'm someone that thinks that taxes are outrageously high in today's day and age. I think when you look at our all-in tax rate, it's going to be closer to 50 to 60% when you factor in income tax, sales tax, gas tax. Every single opportunity the government gets, they tax us. I just talked about in another video the Washington state payroll tax of 0.5% to fund a long-term care insurance program. Now, I'm not talking about that in this video, but you've heard the saying, give an inch, they take a mile. That's what the government does to us with taxes. So today I want to talk to you about a strategy that very wealthy people use. It is a concept, and that is going to be called buy, borrow, die. Now, the most popular way that this is framed online is going to be through real estate. So I'm going to walk you through how it works with real estate first, and then after that, I'm going to show you how to do it if you do not want to purchase real estate. So what they do is they buy an asset. This is a rental property that's going to appreciate in value. After that has built up enough equity, they're going to go to the bank and they're going to say, hey bank, I have this asset that is appreciating in value. I want to borrow against it, and I want to take that money and go do whatever I want with it. So the bank is going to give them a loan, and because loans are not taxed, they will receive that money tax-free. Now, a lot of them, what they'll do is they will take those proceeds and they'll go buy more rental properties. And these rental properties are going to allow them to rinse and repeat this process on autopilot over and over and over again. So they essentially are escaping the tax system. So very simple. And then when they pass away, they sell off the assets, it pays back the loans, and their family ultimately gets whatever is left over out of the equity, which if you play the game right, you buy appreciating assets, it's going to be a lot more than what the outstanding balance of the loans are. The best way to do this, in my opinion, if you do not want to use real estate, because you can use this strategy with a lot of different assets, just for the typical average Joe that doesn't want to invest in real estate, the best way to do this is actually going to be life insurance. Because life insurance, when it's used properly, and I know there's a lot of chatter online about properly structured life insurance and all that, but it's really simple at the end of the day. If you set up the policy right, it's going to build cash value. You can use that cash value, post it as collateral in order to obtain a loan, and then you can use that loan and spend it tax-free because, again, it's a loan, and you could do whatever you want. So here's how it works. You're going to have money going into your life insurance policy. Money goes into this policy. I'm going to erase, I don't know why I put an 8 there. I'm going to erase the buy, borrow, die there. So you put money into this life insurance policy. That is going to build equity over time. And if you haven't seen my video on how the cash value within a life insurance policy grows, you can find that on my channel. I will link that below. I'm still figuring out YouTube and how to put like the cards at the end of the videos. So I'll try to figure out how to link it at the end of the video. But you put money in to your life insurance policy. This life insurance policy, if we're using an IUL, it's going to grow and mirror the growth of the market. If you're using a whole life policy, you're going to get a dividend and then some guaranteed growth. Now, I use IULs at my firm 99% of the time. I have a whole life policy that I own myself. I like IUL much better. So this life insurance policy is going to grow with the market, and then you can go to the bank, and you're not going necessarily to the bank, you're going to go to the life insurance company, and you're going to say, hey, life insurance company, I have this cash value. It is going to continue to appreciate over time. I want to access some of this money, but I do not want to take a withdrawal, because if I take a withdrawal, number one, you're not going to be able to earn interest on this compounding base anymore. But if you're withdrawing some of the actual interest that was credited to you, that's going to be taxed. And so I'm going to talk about in just a second why we take loans from life insurance policies. One of the many reasons. So we take the loan, insurance company gives us that loan, and we get that money tax-free. That is how it works. Now, most people are using this as a retirement income source. Very simple. They put money in, and if you have a mortgage, make sure you watch my video on mortgage-free life, because we can show you how to essentially use what was your mortgage payment to fund this entire process right here. You put money in, you build up equity, you borrow against it, and then you rinse and repeat the process. You take that money, you can spend it in retirement, you can buy rental properties, you can put it into a business, you can do whatever you want with it. It's your money, there's no regulations. Now, another reason that we do not want to take this money out as a withdrawal is because while you are taking this loan from the insurance company, they're going to continue to credit you, they're going to continue to credit this account interest as if you never took a loan against it. So let's say that you have $100,000 inside of this cash value account and you take a loan for $100,000. Well, they're going to continue to credit this interest as if you never took a loan against it. So if you earn 10%, they're going to credit you $10,000. And now your cash value will have $110,000. Now the asset, the compounding base, is off 110. You took out a loan for 100, and then you got now 110 is what is actually getting credited interest. And then we continue to rinse and repeat this process over and over and over again. Right? And when you pass away, when you die, we'll put X's there for dying, well, there's a death benefit associated with this life insurance policy. And so that death benefit is what's going to pay back all of these outstanding loans, and your family will receive whatever residual death benefit is left. So very, very simple process. Much easier to do this with life insurance compared to most other assets. Definitely easier to do this with life insurance than like your 401k, mainly because your 401k actually can't do something like this. You can't loan against your 401k like you can with life insurance. I know you can take loans against your 401k or from your 401k. It is not the same concept as life insurance. Now, I know I said watch the other video. Real quick, I'm just going to explain how the cash value inside of a life insurance policy actually grows. Just as a refresher. So like I said, you put money in to your cash value. Think of this as equity, right? That's exactly what this is. This is your equity inside of your policy. And we're going to talk about an IUL in this example. So when you put money in, your cash value, your equity is growing. It is going to mirror the growth of an index, okay? Typically, it's going to be the S&P 500. Now, it's not invested in the index, but it's going to mirror the growth of the index. And so whatever that return is, either at the end of the month or the year, or however your segments are set up, which that's a whole nother conversation, let's say it's 10%, that money gets credited to your policy's cash value. And then just like I explained at the beginning of the video, when you want to take a loan from the insurance company, this process is going to continue regardless of you taking a loan. So you take the loan, they give you the tax-free loan, and they will continue to credit your policy's cash value as if you never took actual, as if you never took a withdrawal. Okay? Very, very, very simple process. And so in a worst case scenario, because I know some people are going to be thinking that, where does this blow up? Well, they don't necessarily blow up because over the long term, you're going to see about a 1 to 2% spread in between loan and cash value growth, which means you always stay ahead of the curve. It's always positive arbitrage over the long term. In the short term, there will be down years, and when you have a down year, the interest that you have to pay on that loan, it comes out of this policy's cash value. This is a 10,000 foot overview. I have another video that's much more in-depth on this process. But this is how you implement the buy, borrow, die strategy using a life insurance policy. This is how very wealthy people are doing it. And if you own a business, you can do this on a tax deductible basis. So you can actually use your business to fund your insurance policy. your insurance policy so you could get a tax deduction on the way in, about 50%, about 50% of it is going to be taxed like a Roth, 50% is tax exempt. Those are rough numbers. It's going to change a little bit for everyone's exact scenario. And then you let that money grow, and then you use that as, you know, some type of long-term income source or whatever you want to use it for. But you have a lot of options here. Anyway, that is one of the ways to implement the buy, borrow, die strategy using life insurance. If you are still watching this video, I appreciate your time, and I hope to see you in the next video. If you have any questions, leave it in the comment section below. I would appreciate a like or a subscribe to this video. Take care. Have a great day. Bye.